The new millennium starts off on a bullish stance after a historic and mainly bearish decade. 23 to 26 emerges as a contentious range with plenty of mostly horizontal patterns forming in and around it. Of note is the small and slightly inclined head and shoulders reversal among the series of double bottoms. The 23 to 26 range widens the base of a large descending triangle that is invalidated when a sharp downswing forms well above the descending trend line in September. Technically, the triangle could have been expanded and horizontally widened to form a valid and much larger triangle outline, but that would have been less practical, especially as a bearish acceleration was likely after the breach of such a major range like the mid-20s. After a reverse head and shoulders begins a sizable recovery, there is naturally strong resistance back in the mid-20s. The uptrend is strong as a large head and shoulders quickly fails, and is followed by a moderate bearish reversal from a smaller and successful head and shoulders. As expected, there is support in the major long-term range for a slow double bottom reversal to end 2002. This leads to a sharp peak with another formation showing flat top, triple top, and sharp head and shoulders price action to correct the short-term bullish overextension. Not surprisingly, the mid-20s range holds firm, even after another head and shoulders drops trading down to 26.95 and end 2003 similar to 2002. An uptrend line from the earlier reverse head and shoulders is validated even more as it serves as a precise neckline for the late 2003 head and shoulders. It then continued to run through many swing points, even after price crossed over and under it several times. This certainly will be a highly influential uptrend line for years to come, since it marks the site of another failed head and shoulders. Further bullish context on the same approximate trajectory sees a head and shoulders reversal quickly countered by an inclined double bottom to begin another new year with a bullish stance. The general uptrend is still in full force. Potentially bearish ranges have limited drops, and often have inclines to become part of larger bullish continuations. Gaps are less common on commodity futures charts, but it is interesting to see a gap up off the major uptrend line. It is followed by stable bearish retracements that don't fill in the gap for a highly aggressive bullish continuation. These developments are summarized by an ascending triangle. Another instance of long-term bullish strength with a classic resting phase range near the uptrend lines for large-scale 3 methods rising price action. The ascending triangle's uptrend lines will be the main focus now, since they represent the steeper incline and have great influence, as the least bearish kind of double top has limited bearish impact. The inclined double top is a perfect pattern for a minor bearish retracement to stabilize the steeper long-term incline. The inclined double top expands into a less strict inclined triple top that almost serves as the upper boundary for a channel with the lower uptrend lines. Naturally, the moderate correction is halted at those lower trend lines as a double bottom forms another steeper incline. As global uncertainty in the run-up to the 2008 recession loomed, oil was also eventually to be under pressure. This took the concrete form of a double-top peak that eventually saw even the strongest support area breached. It was, of course, as the recession began in full force. Even the lowest trend lines and the 66 to 68 range intersection only offered temporary support to the strong drop. Approximate long-term downtrend lines can be helpful guides as a descending triangle fails. The broader 32 to 48 range ends up being a large triple bottom to start a solid long-term reversal. The uptrend is sustained by a double top that only produces a minor bearish retracement. That is normal since the uptrend lines from the triple bottom continue to present firm support to begin establishing back over the mid-60s range. Similar to years past, the uptrend lines are crossed, but still retain influence. The overall uptrend is a shallower and more stable incline after another great example of a failed head and shoulders. This one has a flatter right side, as opposed to the more noticeable incline that is often seen with the final upswings. Similar to stocks, commodity futures charts will still see major contention around the 100 price boundary. This is clearly seen as a large and flat head and shoulders peaks with a sharp double top, only to have the steep downtrend reversed by the near immediate formation of a large double bottom. The head and shoulders range offers strong resistance, as would be expected after prolonged range-bound trading briefly moved over 105. This is why the ascending triangle inclines had limited results, followed by the transition to another head and shoulders formation. Price action was neatly contained within the pattern outlines for stable downtrend lines to reference. The flat top and smaller head and shoulders demonstrate bearish reversal patterns in more of a continuation context during an established bear market. After the long-term downtrend line above 3410 is crossed, a double bottom reversal is highly likely. The uptrend is stable but encounters immediate resistance at the mid to upper 40s. This is normal considering the bearish climate before 2016. Interestingly, August has the less common price action of a long-term downtrend lines supporting influence after the chart briefly moved above it. Later, it turns out the relatively minor August upswing was significant as it was the decisive consolidation over the old descending trend line. As expected, the mid-60s provide immediate resistance upon first contact, since the range is a key long-term boundary, though the bullish recovery is still healthy as a noticeable incline establishes after the double top drop reverses. An ascending triangle still results in a long-term bullish continuation, but it is more gradual and tenuous due to the double bottom that reverses a volatile drop in late May. This invalidates the pattern to some degree, but the old 68 to 66 range remains a helpful reference as a minor declined double top is countered by an inverse head and shoulders reversal. While there was immediate support at the 66 to 68 boundary, it was soon breached by constant 3 methods falling price action. 2018 actually represented the break of a large upward channel that neatly contains the aforementioned patterns. 2019 starts with the completion of a unique reverse head and shoulders. It has its main outline with a sharper head and flat shoulders. The right shoulder has ascending triangle features. The ascending triangle in turn has an extended upper boundary due to the immediate proximity of the final 3 methods falling formation from mid-November. This is certainly no strict reverse head and shoulders outline, but it does represent a gradual bullish reversal with a sharp central upswing being the head. On the flip side, there is soon general head and shoulders price action, as the flat shoulders under 6650 are followed by 3 methods falling price action for another bearish acceleration. Although 54.75 to 50.95 offered firm support, with a double and later triple bottom range over the old 48 to 46 range, it was under increased pressure. The appearance of a strict declined head and shoulders right after the double bottom was a sign of bearish strength quickly countering any uptrend. Sharp spikes in September and January were short-term bullish overextensions, adding to the shift into a more bearish long-term situation. In mid-April, attention focuses on a potential double bottom range under the wider gap down range. The possibility of a later triple bottom is quickly forgotten, as a sharp bearish overextension took place during the historic drop into negative territory. Interestingly, this created 3 methods falling price action to breach the 20 level that offered less resistance in May, even with the intersection of the descending trend line. It was mainly due to the aforementioned bearish overextension. It was certainly a more passive recovery, due to the severe drop that was even more extreme since it followed a failed triple bottom and gap down. More stable price action was seen into the second half of 2020 with natural resistance slowing down the uptrend. Notable resistance was the intersection of the upper downtrend line on 3250 and of course the gap fill itself. The old lower 30s range continued to provide remarkably precise and immediate identification of strong support. This also marked the expanded neckline of a formation that has many head and shoulders qualities, but is not a strict head and shoulders. In the end, it doesn't matter how strict the head and shoulders features were, since 3 methods rising price action negated bearish context and sharply continued the recovery. Similar to other periods, an established and stable long-term trend contains a series of 3 methods price action formations. In this case, a series of 3 methods rising price action forms a solid uptrend line for the larger bullish recovery. Along the way, old ranges and levels of significance from previous patterns tend to provide precise identification of where resistance slows down the climb and presents potential to halt the trend.